Bitcoin regains the 100K level after holding key supports over the holiday period. With the long-awaited inauguration due on the 20th of Jan, crypto markets may catch another wave of optimism. And options flows continue to be dominated by calls and call spread buying, all the way out to March this year. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my man Dave from FRNT, and Happy New Year. How's it going, man?
Yeah, Happy New Year. Yeah, very good. Yeah, excited about the new year.
Bitcoin back at 100K. It didn't really do that much, did it, over the holiday period? Just chopped around.
No, obviously, so it's funny because last time we were in here just before Christmas, I think we came out of the studio and we had that pop up to 108K.
Yep.
I thought our bet, 110K.
You've got to learn now to not bet against me.
Yeah, I won't bet against you. You're more of a trader than I am. I'll claim that the macro directionally, I feel like I was right, but
mate, to be honest, I think it was luck more than anything else.
But like, I talk a lot about liquidity, and maybe I was a bit naive. I mean, we knew like the year-end liquidity was always going to be a challenge. Like Bitcoin's always done like quite good over that period, but it feels like liquidity is becoming more challenged just generally, like in traditional markets, and you're seeing that around like these quarter-end periods, and that was really apparent again in this year-end, quarter-end, month-end, into December. So like we talk about the RRP, the reverse repo, which is the cash that gets parked overnight at the Fed. So that always goes up into like month-end, quarter-end, into these periods because banks window dress their balance sheets. So they don't get charged, basically, like the capital charges, and it's like a snapshot of the balance sheet. So they all stick it on the overnight repo. So it looks like they're not as risky as they are throughout the rest of the quarter. Right. Anyway, that rose nearly 400 billion. So you can think of that like 400 billion of cash being taken out of the market in those last couple of weeks of December. So I think that played a not insignificant part in terms of just knocking crypto back down.
Although it's not like the downside was that dramatic.
It wasn't, no. But I mean, from 108 to, I forget how low we got.
92-ish.
Like yeah. But now, like since the new year started, about 230 billion of that has been returned to the market. So it's kind of like, well, yeah, of course we're back above 100K.
Yeah,
so,
this often happens. I mean, equities saw the same thing.
Yeah.
Equities were weak into year end, and then first 2 days of the year, boom, we're up again. Right.
So I mean, there's so much noise, right? You get everyone, all the bears jump on this is it, this is the big sell off, and it's like, no, guys, this is just like market liquidity and position adjustments into year end, so that you come out the other side of it. Not only is liquidity returning, but people got fresh bullets to play with into the new year, so risk is getting put on.
Debt ceiling's been hit.
Debt ceiling's been hit.
So what's that implication?
I think Yellen said they're probably all right for a couple of weeks of Jan, and then they're kind of out of money. They will.
No big deal.
No
US government's out of money.
Yeah. I forget the phrasing she uses, but basically, extraordinary measures. They'll first go to extraordinary measures, which my translation of that is they're kind of just like robbing Peter to pay Paul, and there's certain things they'll stop paying out. Yeah. So that'll delay a little bit the drawdown of the TGA, but effectively they'll draw down what we call the TGA, the
Treasury
General Account, which again is like the Treasury's cash account at the Fed. They've got around over 750 billion in that. So they're going to draw that down.
The rate of that being drawn down, like, is that going to happen all in Jan, or is it over the course of
probably
many months?
Over the course of a couple of months,
okay,
a few months, and again depends when the debt ceiling gets lifted. That then obviously that process sort of ends. But there's probably like given as well in December they cut the repo rate by like 30 bips, a technical adjustment, but essentially it's an adjustment to drain out the reserve repo. So there's potentially around 230 billion, call it, from that comes into the market. There's probably about another 500 billion from the TGAs get drawn down, that we'll probably see. So you might in this first quarter have around like $700-800 billion of cash essentially come into the market. So that's why I'm quite constructive like from a liquidity viewpoint, like coming into this first quarter, where we might actually have a discussion where you know, I'm looking a little bit more bearish on everything, will be when the debt ceiling gets lifted and then they start issuing again to rebuild the TGA, and then they'll be sucking all that liquidity out, and we'll probably go through. So in my mind, again, see how these things work out time frame wise, but I think Q2 of this year could be where we see like the 30%, 40% drawdown in crypto, and equities become a bit more challenged. Doesn't make me bearish for the year, because then again this liquidity picture starts to pick up, and
oh my God,
and again there's a lot to go on.
First time I've ever heard you mention that, like that 30-40% drawdown.
I laugh at people like obviously I've been bullish really again, just following the macro cycle and liquidity cycle. Been bullish now for a couple of years. I think everyone's gonna shit themselves when I start
when you're
talking bearish.
Yeah. Hilarious.
But you know, everything's different, and who knows? I mean,
but that's the thing. You know, people who wrongly claim that you're a perma-bull, you're not. You're just being true to the cycle.
Yeah,
right?
exactly. Yeah.
Yeah. But what do you think about this inauguration then coming up in Jan, 20th of Jan? Is it really a catalyst for the market? Is it a bit of a, well, we know he's coming in, so what?
Yeah, I don't think it is a catalyst now. I don't think it's a buy the rumor, sell the news event. I mean, the potential catalyst could be who knows what he's going to do with this the Bitcoin reserve.
Yeah, I think that's what the big discussion will be around.
Yeah. Right. I mean, I forget what the pricing is now for that. Like, I think it's around 40% or something that they think it gets done. So it's still not priced to be done. Okay. You know, could he sign an executive order to do it off the bat, or will he just disappoint? So I guess there is potential for volatility around that if he doesn't mention it for a while, and everyone's like, oh shit, I thought we were going to get, you know. So there probably is something priced in for that.
The vol surface isn't really pricing much for it though.
Yeah. So that's interesting. Yeah. That's interesting. So, and then, I mean, if he does do it, if he signed an executive order and it becomes a reserve asset, I don't even know if he can price it, because the demand that's going to trigger, then I think we're in for a ridiculously big move. So I still think there's going to be a really positive flow dynamic for crypto this year. Again, we'll chop around these liquidity machinations and stuff. See what the Fed's going to do is important. I think we're underpriced for the Fed this year. I think we've priced out far too much. I think the Fed flipped hawkish in December, probably when they shouldn't have done. Because my view is that we're living off this sugar high from the pre-election spending, and we've had this really good little data run, but actually already you're starting to see data disappoint relative to expectations, at least. So economic surprises are turning negative. So, and just look at the slowdown we're seeing globally, and none more so than China.
What's the deal with China now?
Man, China is in a deflationary spiral. I think their stock market's had the worst sort of start to a year since like 2016.
Well, how much are they down? They're not down that much, are they?
No, but it's like, yeah. Again, it depends what exchange you're looking at. But like, capital's definitely leaving. They're definitely under pressure. Interestingly, though, they're letting the currency go. They're starting to let the currency slide. Now, it's not been an outright devaluation, but we're trading well above that 730 level that we've spoken about before. Now, I've been a proponent of saying when the Chinese currency is under pressure, it tends to keep Bitcoin, like the lid on Bitcoin. I think partly because they're typically intervening. So when they intervene, they sell their FX reserves, which kind of soaks out liquidity from the market. I also, which is maybe a little bit more controversial and contested, I also think they like to try and keep a lid on Bitcoin to discourage the capital outflows, which is they probably still want to do a bit. But I think the fact that stocks are under pressure, they seem to be like, I keep calling this kind of crawling peg. They're kind of slowly letting the currency go. I think that's encouraging capital to flood out. Now, China has capital controls, right? So it's not easy to get capital out of China. But the one place you can do it is in Bitcoin. So I think this is a positive dynamic for Bitcoin from again, a capital flow story. I think there'll be money flowing into that. Really interesting, though, is that the currency weakness and dollar CNH going higher is not feeding into broader dollar strength. So actually, obviously, we had this pop higher post-Fed and everything, but the dollar to start the year started to sell off, despite dollar CNH being pretty bid, which tells me that they're not intervening. because when China intervene, the way they intervene is they sell dollar CNH, and then because they have the like their ratios of FX reserves are pretty fixed, they then have to buy the dollars back against say euros and sterling and yen and all the other currencies. So basically it drives a broad dollar bid. So the fact that the broader dollar has actually kind of softened over the last few days tells me that they're not really intervening. So you're not getting that liquidity sort of being sucked out. Meantime, you're probably getting these capital outflows.
The dollar, on the dollar point, it's also the market's kind of cottoning onto the idea that tariffs aren't going to be as harsh as Trump might be talking, right?
Yeah, exactly. I think everyone kind of gets, or they should get at least that. That's just he's everything's negotiation tactic.
Exactly, yeah.
And I think with China is going to be really interesting because, like, ultimately all Trump cares about are trade deficits, right? Now you're not going to improve the trade deficit if the dollar's just bid to boots. And at the same time, you've got the Chinese consumer that's really under pressure. So China really needs to stimulate. And obviously, we're seeing all this talk around fiscal measures, some of which now they're looking at, direct like consumer focused measures, which is good because before it's always been about the supply side and what have you. But in order to stimulate and launch this massive stimulus, well, obviously that's going to put the currency under pressure, which is going to make the dollar bid, and it offsets. Now we know Scott Bessent wants a weaker dollar, Trump wants a weaker dollar, so I kind of feel the US have a really strong hand to play, just given how the precarious position that China's in. So they have a really strong hand to play. So I think China are going to want to come to the table and say, look, how are we going to do this? And I kind of feel like we're going to get maybe some sort of Shanghai Accord type agreement where they'll work together to keep the dollar weaker and maybe broadly weaker. So you guys go stimulate, you get your consumer going, we keep the dollar weaker so you can buy more of our stuff and try and address that balance whilst also kind of stimulating your economy. They'll probably give some kind of, we'll invest in some US businesses and then Trump will be happy. That's kind of how I think it would play out. And what will be really interesting is if we see Xi at the inauguration that there's talk about he's been invited to, if he turns up to that, I kind of think that's like, look, we're here to play ball. That for me would be a just all in buy everything risk. Like stocks are going to fly, Bitcoin's going to fly.
Positive signaling, basically.
Yes, I think that'd be a positive signal. Obviously, Trump is always the unknown. He's very volatile. Musk seems quite volatile at the moment. So how long that relationship lasts?
Musk has got to be in his bonnet about the UK government, right?
Yeah. I mean, he's been just all over hammering that.
Cool. So that's a great macro summary for this week. But who did you catch up with?
Yeah, so really interesting conversation this week. So we had the big boss man himself, Luke Strijers, Deribit CEO. And we had Leo Mizuhara, who's the founder and CEO of Hashnote. So like an asset management business, but interestingly, they've got a money market token, so yield bearing sort of token, stable coin essentially, that Deribit are now actually using as collateral as well on the Deribit platform. So really interesting conversation, and yeah, have a listen to what they got to say.
Hey guys, welcome back to the first edition of Crypto Options Unplugged for 2025. Delighted this week to be joined by the big boss man himself, CEO of Deribit, Luke Strijers. Welcome, Luke. And also another special guest, Leo Mizuhara, founder and CEO of Hashnote. Welcome, Leo, and Happy New Year to you guys.
Happy New Year. Good to see you guys.
Happy New Year. Thanks for the invite, David.
Yeah, you're welcome. Well, let's jump straight into it. Obviously, regular viewers need no introduction to Luke and Deribit. Leo, it'd be great to hear a little bit about your background and exactly what you guys are up to at Hashnote.
Yeah, well, thanks for having me on the podcast. My background is primarily in traditional finance. So I was in traditional finance for 17 years, 12 years at Bank of America. In the end of my time there, I was in the corporate investments group, running their part of their portfolio. And then from there, I went to DRW. I ran the systematic options trading group at DRW. And then we started Hashnote directly from there. Hashnote itself is an on-chain first asset manager, and we're best known for our USYC tokenized money market product. And that's the product that we have integrated into Deribit and have worked together closely with Luke to make it really, I think, the most liquid and the most dependable yield-bearing collateral out there.
Okay, interesting. So obviously there's a few tokenized sort of money market securities out there nowadays. Yeah, just interested to dig a little bit deeper into USYC, what the yield that underpins that, where's that generated from, and just learn a little bit more about that.
Yeah, I think we're very unique in that particular sense. The way that we generate yield is different from most of the other money market funds. We call it a tokenized money market fund because that's the zeitgeist, right? That's what people know and understand when they hear it. We really think of it primarily as a tokenized collateral asset and or a yield-bearing collateral asset. And the things that you optimize for might be different for a collateral asset versus what we could traditionally think of as a money market fund. I think so. If you think about a money market fund in traditional finance, like what do you normally think about? Like what is the thing that you expect out of a money market fund?
T-bills.
T-bills, sure. Money market funds traditionally are either credit funds, commercial paper, or government money market funds, which involve treasuries or T-bills. And they are usually savings vehicles. People think of them as ways to save money for the future. And in that case, you're optimizing for yield, you're optimizing for safety. Whereas when you're primarily thinking about collateral, you might be thinking about a different dimension, which is primarily liquidity. If I'm a trader, I need my collateral to be super mobile. And that's really what we've been optimizing for. And I think it's one of the things that tokenization, or the advent of blockchain-based transactions, really excels at more than anything in traditional finance, which is why we thought this would be where the space would take off first. In order to do that, our funds are 100% in cash and reverse repo. So we're in cash during the day, and then overnight, we're in overnight reverse repo. And what that means is that we have the ability to 100% redeem our funds same day if necessary. So if you pinged us and said, okay, it's like, whatever it is, 10 a.m. or 7:40 a.m., I guess right now, Eastern time, and I want to withdraw 100% of my funds, or really everybody in the market came to us and said, we want to withdraw all of our funds right now, we could get those wires out today. We can also redeem in stablecoins today. And that's a guarantee that no other tokenized money market has. And I think it's one of the things that makes us unique and particularly good collateral if you're a trading firm, because you want that money to be mobile. You want to be able to pull it out of one place, call it Deribit, being able to move to the CME, bring money back from the CME, put it back to Deribit, and do that in a seamless and almost instantaneous fashion.
Interesting. Who do you guys use for custody on that, on the traditional security side of things?
So our reverse repo is done through Merix, and the funds themselves are Bank of New York Mellon via that Merix account.
Yeah, interesting. So how did the partnership with Deribit come about? I don't know if Luuk, if you want to speak to that. Yeah, how you guys decided to work together.
Yeah, so I think in the end, for us, we are an institutional platform, as you know. So we have like 85, 80, perhaps even higher, depending on the metrics. Percent of our business is institutions, looking at volumes, looking at open interest, looking at assets entrusted to us. So the mindset is institutional. So some years ago, the push for cross collateral started, where clients is the bigger, of course, the more focused on those kind of questions. And cross collateral initially started out with BTC versus ETH, which are the dominant products. But over time, especially when new firms joined, the focus on dollar-based products became more imminent. So the crypto native people, they're heavily committed to trading Bitcoin or Ether or whatever they prefer. And nowadays, or since quite some time, they can use their BTC, for example, to trade ETH. But the newer institutions, the later wave, the second wave institutions, they focus on dollar-based products. They have difficulties in accounting for BTC. They have difficulties in essentially treating it. A common theme throughout the market. So that's the success of products like USDC, USDT. But nowadays, the success of yield-bearing collateral like Hashnote. So we often had discussions about how to best structure this, and typically we listen to our clients. So we rank them based on client demand, and Hashnote and Leo's network is simply first of all more vocal, and the product was appealing. So we like the liquidity metrics, we like the way it's designed, we like the fact that we can redeem it 24/7, we like the way the market makers show support, we like the way clients show support. So we initially said, look, now we have cross collateral. We started out with BTC and ETH and the typical other products like USYC, USDP, but we want more. So we launched Hashnote first of all, but recently, for example, we added gold as well. In the end, we want a versatile basket of key products where we think institutional clients and the more sophisticated traders will benefit from, and that's what we're seeing now. So the extra yield generates more portfolio income. It allows traders to allocate to yield-bearing collateral when not trading. So it doesn't have to be collateral; it can also just be a yield-bearing asset. And the feedback is positive. So yeah, we like the partnership. So, but it came about some time ago, perhaps even like 2 years. And it took some time to actually properly develop and allocate within our roadmap, but now we have it. We're happy.
Yeah, I think what Luuk was saying about the institutional involvement is really important there. I think the typical trader, the retail trader, may or may not be quite as capital efficient. But when we think about institutional capital allocators and institutional trading firms, they're super sensitive about that capital efficiency. So back at DRW, when we were looking at high frequency trading opportunities, we'd often see that there is an exponential increase in the number of trading opportunities you can go after when your hurdle rate is lower. So if you can go from a 25% hurdle rate, which is pretty typical for a trading firm, and you can bring that down to a 20% hurdle rate by making your collateral yield some, that really gives you a lot more opportunities that you can go after and really can increase the volumes for the number of trades that a trading firm will care about.
Yeah, interesting. And is the full yield passed on to the holders of the USYC?
It is, yeah.
Yeah, interesting. Yeah, and what's, I guess the primary benefit for Deribit again is just in terms of the expansion of that collateral collateral set.
We don't charge for custody, we don't charge for assets. So for us, it's just to facilitate clients. In the end, we want to make sure that all institutions would prefer Deribit as their destination. That might be perhaps too far-fetched, but in the end, most of them should be comfortable with what we have to offer. That means trading perspective, it needs to be fast. We have stuff like co-location, cross-connectivity. We have multicast. We have all kinds of technical stuff that appeals them. We have the products they like. We have a regulatory stamp from FARA here in Dubai. We're expanding the regulatory framework globally. It's simply ticking the boxes. We have stuff like SOC 2 ISO certification, and we didn't have yield-bearing collateral. So that's simply one gap. And I know that Leo would say this is the one and only missing one that completes everything. But for us, the roadmap is big. We want all the institutions that are still to come. So I think we all believe that there's tremendous growth still coming. That means that many asset managers, hedge funds, banks, you name it, all of them still have to join. Now that Trump's getting in office, the things might change in the US. The regulatory framework might change. But perhaps the launch was started by the ETF. Step one is just whatever, simple blockchain transactions. You go to some cash market and you buy some Bitcoin. Step two, or the alternative would be ETFs. But the next one would be capital efficiency via derivatives. And in order to offer those people what they need, what they typically expect, it requires yield-bearing collateral. They used to trade all markets globally the same way they expect to trade crypto as well. And that's the missing link was yield-bearing collateral. So the bigger the market will get, the bigger the need for efficient capital becomes as well. So I think every percent the market grows, the collateral need will grow equally, perhaps even faster, because those guys are more traditional than the current ones active today.
I think that's right. The big banks and the more traditional institutions that are not yet in this space, I think with Luke's leadership, the way that Deribit is placing itself, it's going to be one of the places where they want to go first, right? This is one of those places you can depend upon to do the professional thing, to be safe, to be regulated. And when they're thinking about whether they're going to trade the CME future on Bitcoin or the Bitcoin perp on Deribit, I think there's a really good argument for why you'd want to be on Deribit due to the capital efficiency, due to the speed of the collateral, and due to their regulatory construct.
Yeah, it's interesting. I know as well. I mean, I always say like we kind of we're kind of repeating some of the evolution we saw in TradFi, right, in crypto, but we're just doing it at a rate of knots. We kind of, you know, compressing decades of evolution in TradFi into a really sort of short space of time within crypto. So it's great seeing these sort of products actually come in and develop and then being adopted by the exchanges like Deribit, which is, yeah, it's just really exciting to see. I mean, on that, Leo, what do you see as these products start to develop? Like, what do you see in terms of ahead for the evolution of these tokenized money market securities?
Yeah. So one of the things I think is really important is that the majority of money is still primarily in traditional finance. And so the thing that we should be aiming for is how do you get traditional finance onto platforms like Deribit? And then how do we get things like USYC onto places like CME? And those things are going to feed off each other, right? If USYC can get approved by the CFTC and can get on CME, then the firms that are used to trading on Deribit are going to have a great time being able to move that collateral back and forth between the CME and Deribit. If those firms who are on CME start using USYC because it's faster and more efficient than using traditional methods like wires, then they're going to start using USYC. Then they're going to look over at Deribit and be like, oh, well, we might as well trade there too, because it's so easy for us to move the capital there. So I think the next big step for us is seeing that blend between TradFi and kind of crypto CFI, if you will. And I think it's just around the corner. Like you said, the administration is about to change in the US, and I think that's going to be a big change. The CFTC has already had multiple conversations along these lines of, if they're accepting ETF money markets, then they should be wrapper agnostic and be able to accept tokenized money markets as well. So that discussion is already going on. And I always think back to my DRW days when we would move capital. If you move capital from the CME to Eurex, for example, that used to be a T+3 activity. So it took me 3 days to get cash from Chicago to Germany. Like I could literally just put cash into a box and like FedEx it over faster. And so we're really moving into this new era of finance where we can really expect finality. We can really expect that cash transaction to be moving from place to place within seconds. And that's big for trading firms.
Yeah, for sure. And is a lot of the in terms of sort of growing the network and usage of USYC, is it very much sort of focused on this sort of collateral piece, just sort of more exchanges integrated and users of it? Is that kind of the plan?
That's right. We're working on this on kind of 3 prongs, I would say. First, it is indeed the exchanges and making sure that we have the best approach with exchanges and the ability to provide that collateral. Tied together with that is having the best liquidity. So I think we have the best instant redemption guarantees in the market. Right at this exact moment, we can redeem up to 400 million in USDC instantaneously. Like literally, you can go to our smart contract and get USDC for your USYC. Nobody else in the market can do that. And then third is, again, related to liquidity, but market maker and trading firm support. So making sure that every market maker is onboarded and they're able to trade at all these venues using USYC. And I think we're making good headway on all of those. And we're actually pretty excited. We have an announcement coming up later in January that will make that liquidity piece even more powerful. So yeah, I think that fungibility between our product and any of the cash products, whether it's fiat or stable coins, is super important. And it's going to be a huge part of our push toward market dominance like this year. We're actually currently already bigger than BlackRock Spittle. I think we're more than twice as big as BlackRock Spittle at the moment. And I think this is a key reason why we're able to do that.
But yeah, that's really interesting.
The thing is that it's actually good for it to be multi-market as well. You would assume the opposite, but for us, it's actually good if market makers, if firms that are active on let's say 5, 10 or more markets can move the collateral around as well, because then they can optimize trading, which will benefit those platforms that will facilitate it. So it's actually not a great thing if we are the only ones supporting it, because then it remains isolated and it becomes a silo. It's actually a better thing if money can flow, like from CME to Germany. The same would apply within some exchanges. So if a derivatives platform can offer this via to its peers as well, and we have the same collateral that offers trading opportunities today on Deribit, tomorrow on Binance or wherever, that actually benefits all parties involved, and makes capital more efficient and lowers the hurdles Leo was referring to earlier. So multi-market adoption is like key in order to build this institutional space.
Yeah, 100%. I mean, I spent some time working in the prime broker space, and certainly that the speed or lack of in terms of being able to move collateral around exchanges, it's been a huge problem, and that I guess the fragmentation that we still kind of see in the market. So yeah, the quicker we can do that, more leverage people can save.
Without conversion. So if now you might have to convert your Hashnote into USDC to move it somewhere else because Hashnote is not accepted, or the other way around. And if it's just efficient, then the money can flow. The trading opportunities will grow.
Yeah. Yeah, no, it's it's really good to see that development. And look, how about Deribit? Great year 2024. What's the outlook for 2025, and you know, what are you guys excited about, and how are you seeing this year play out?
And 2024 was an amazing year, as you can imagine. November and December, best months ever. So we initially had our best month in March, and now it became like 106, so 20 billion more in November. So extraordinary numbers. And the question is whether this is the new normal, and the market is crawling towards 100K again. It might be breached when this is aired. And who knows where, when Trump takes office, where markets will grow to. Is this a new normal? I don't know, but it looks very promising. So for us, it's about institutional growth. We expect to expand our. We just launched with Vara, so as the first regulator approving our model. We have the full model approved. So contrary to multiple other market setups, they had like little islands. They have something approved here and something else approved here. We have the full model approved in Dubai, and we are creating brokers globally routing flow to Dubai. So we filed in Brazil, we filed in Europe. So the goal is to have like a European broker, MiFID broker routing flow to Dubai. We're looking at Asia. So in essence, we're building a fully regulated model where all flow gets executed in Dubai in the most regulated way. So besides VARA, we have ISO certification, we have SOC 2 Type 2. We just got the CCSS license, which is about to get announced, or certificate is like a security certificate. We intend to do whatever it takes to unlock clients, which means more collateral, which means we need to have dollars, which means many things, which are still to come. But we will expand the platform. So we will be much faster than we are today in order round trips, which is again key for processing more orders, enabling market makers to quote tighter, enabling books to respond faster. So everything will resolve around liquidity and better pricing, more products. And it's like a circle strengthening itself. We won't expand into, like, let's say 100 new products. We will do it very gradually. We just expanded with gold, as mentioned, but we will add a few more altcoin options. So we intend to have a little bit longer list, but definitely not like 50. It will be a short list, and it will be properly quoted. So we will gradually expand instruments as well as expiries. You have to look at it like traditional markets where there's an index product and single stock options. We look at this the same. DTC needs would be the key index products, and the single stocks would be stuff like BB, XRP, Solana, etc. But the list should become longer. But I don't think the market is evolved or that large to support a massive list. But that's the plan. Multi-instrument collateral, efficient trading, and more yield bearing solutions. So we started with Hashnote, but we are open to more coins. So we expand at the request of clients. And in the end, that's the model. So a limited set of products with a very large client base.
Yeah, sounds good. And how about you there? What's the outlook for you looking in 25?
Yeah, so we're gonna have some big changes coming up. But I think the most exciting part of it is going to be with the amount of liquidity that we're going to be able to provide for USYC and USDC. I think we're already leading the pack in terms of that ability to convert and to turn into that the more liquid form, if you will, of USDC and fiat. And so we're going to push even harder in that direction, make it so that exchanges like Deribit can be really comfortable with this as a collateral and its ability to convert back and forth into the trading pair currency. So like USDC in the case of Deribit, and USYC as a collateral asset. I think that instant liquidation is something that we're going to continue to provide, and something that is going to allow us to be the real differentiator in the market. And yeah, I think by the end of the month, we'll be seeing some interesting things about how that market can change in the near future.
Yeah. And is it noticeable since Trump, or is it too early yet to kind of think about, how this is impacting things from a regulatory side of things? How do you guys think about that?
I think we're already seeing changes. So ahead, Luke.
No, so from our perspective, yes, it's definitely noticeable. So besides volumes, of course, which are noticeable for everyone, I think the push to make the US the let's say the number one market is rippling through all layers of the industry. So people were leaving the US. I think they're considering returning or building new stuff in the US, which wasn't the case before. From a regulatory perspective, I think the doors will open as well. So the lawyers are keen to do business. So before they said the US is closed, and now this conversation is going, what can we do? What can a platform like us do in the US? But also, what should US platforms do abroad? And that there's more expansion instead of protection, which was before. So I think the industry is poised for growth. And the big question is, how is it going to tilt towards the US and outside the US, of course? But I think we'll all benefit regardless where you are, as long as the focus is on quality. So I think whatever, forget about the US, the global regulation is focusing on the same area. So in the end, people will focus on regulation, on quality, on proper standards, on the proper ways of dealing, preventing all kinds of abuse, wash trading, etc. The focus on that will be much bigger than it was in the past. But as long as you adhere to those quality metrics, I think we will all benefit greatly, because the market will simply be opening up to many more participants versus the size today. So it will definitely grow, and we see that already. We see it in onboarding. We see the stance changing. The US is forcing other regulators to consider their stance as well, and is opening eyes of new investors, new trading firms. You see, it started with MicroStrategy, but there's like multiple firms doing the same nowadays globally. All of this will expand. And the same with asset managers, the same with the family offices. These people will lots of them will adjust their model and include a certain percentage of crypto, and a certain percentage of crypto will also be hedged using derivatives on Deribit. So it's all it's all connected. So yes, we'll benefit, and of course Collateral will benefit as well. So perhaps it's even the key driver to making this happen.
I think Luke's focus on quality is exactly right. Right. I think there's a parallel to startup space in general. People often say that your first customers are not going to be your main customers later in your life cycle. And that's something that is also correct within crypto. I think we saw a lot of like first mover advantage, kind of, what we currently call degen type products, right? That became really big really fast because there's a certain type of customer that really gravitates toward that. But this next phase of crypto is going to be all about what the rest of finance is doing and them moving all to on-chain products. And those people are going to be laser focused on where can I get the highest quality product? Where can I get the most regulated product? Where am I not going to get in trouble, right? And it's platforms like Deribit that are really leading the way for that. It's one of the reasons why we really focused on institutional asset management, and we really focused on, like I stayed in the US. I did not move abroad because I thought eventually this has to come back to the US when it's ready to get big. And this next phase, I look at the asset management space a lot, and the asset management space is on the order of $120 trillion of assets under management globally. The crypto space is like 3 trillion. Like it's really fucking small.
Yeah.
And it shouldn't be, right? Because tokenized assets really are a wrapper. It's a way of moving the same types of assets around, but in a much more efficient way, both in terms of time and in terms of fees and cost. So this space has tremendous growth potential. And as the rest of finance moves into this space, it really is going to focus on that quality. And it's going to be players like Luuk and Deribit. I think players like Hashnote. Honestly, other players in the space we haven't mentioned, players like Coinbase, Circle, they're all going to be the ones that are focused on that regulatory first approach and that high quality platform for the major traditional finance firms to get into the space.
Yeah, for sure. And I think that's like for me, I mean, like those numbers you sort of put out. I mean, people say I'm perma bullish on this space, but just when you think in sheer numbers, just I mean, when we've been sort of grinding in crypto for a while, it's easy to think like we're quite far down the road, but actually we're still very, very early. And I think for me, the really fascinating thing post the Trump election is, and it's something I've said before on the podcast, is that before it felt that there was, when I was going out speaking to institutions who are kind of interested in the space, they kind of get it. There was just too much career risk to start like moving into here. And now it feels like something's flipped where the career risk is now not being involved. So like you say, now the questions become, right, okay, how do we do this? How do we engage? Who are the institutions, the platforms, that we need to actually kind of, that are having sort of TradFi level institutional standards that we can kind of trust and come and play on and get involved in this space.
That's absolutely right. Like, I think previously, like you said, if you were involved in crypto, there were like, it was a real career risk. People thought you were crazy. But right now, if you're an RIA and you didn't put your clients into Bitcoin last year, all your clients are like, what the fuck? Am I allowed to say that on this podcast? I don't know. Like they're really sitting there going like, you just had me miss the doubling of an asset class that everyone was talking about, and you just wouldn't let me into it because like, you didn't want it, you didn't like it, you were listening to Elizabeth Warren. Like, what's going on there? And I think it's a real career risk at this point to not be paying attention to the space.
Yeah, I as well, from an FX background and sort of trade FX options and stuff. I still can't get my head around how, if you're a vol trader, you're not looking at the vol in crypto and saying that I should just be in that space, and you're not coming on Deribit and employing your strategies there. It's it's bad. But I think now that awareness is there, and I think 2025 is we're going to see some acceleration in this industry, because I still think, despite price, we were kind of in obviously price for being in a bull market for a while now, but industry wise, we were still kind of in the depths of a bear market until really towards the tail end of last year. So I really think we're going to see the industry accelerate, and excited about where that leads.
The difference in overall stance and in regulatory willingness to review, because many frameworks are not there. So if you look at global frameworks, typically it's about spot. So spot were the first problem, so that got addressed first. Now you see some stablecoin models in the making and some derivatives frameworks. But like us, you can't get regulated globally because it simply doesn't exist yet. But what's happening now is that those global regulators that see the push for the US to become number one, and they're waking up as well, and they realize, should it be the US, should it be us, should it be Hong Kong, should it be Singapore? All of them are considering what to do next. And that stance, that change in approach is triggering the industry, of course. If your regulator is willing to review a Bitcoin model or a derivatives trading model where digital assets are used as collateral, where stuff like Hashnote can be included, why shouldn't the industry adopt it as well? And that's what's happening now. So the US election or the change in leadership is triggering this global trend of reviewing an asset class that might have been dormant from their perspective, or at least out of reach, and it's becoming in reach. And that's, I think, the biggest thing. So we're talking to many firms, which takes ages to onboard a traditional firm. So in order to onboard on Deribit, it takes you, let's say, 1-2 days as a retail client, and a few days as a corporate client if you have all the stuff available. So if you have all the documents, you can onboard in 3-4 days. We will ask some questions, we do the risk test, so the reviews, etc. But for them to onboard us, it takes much longer, of course. So for them, this didn't exist 2 years ago. It was just us onboarding them. But now it's them onboarding us because the firms have risk team, compliance team, etc. And they review everything we have. So all the documents, all the Q&A, all the questionnaires you can imagine, they will send, and we have like a full team on it and sending all of that stuff. But that starts now. So we see those firms joining. They won't send their initial first trade before, let's say, June. It will take months, and we will have interviews, and we have to submit all kinds of stuff, and they will have all kinds of meetings internally. But they will start trading, but because we see them coming now, we will know that it will take some months, and that's happening. So the review is taking place. The interactions with those larger firms is taking place. And once all the boxes are checked and the custody is done and all the reviews have done, they will start trading and allocate money. And I think they will choose yield-bearing collateral because that's simply the way they're used to trade. So that we're ready to welcome them. So that's what we're building.
Well, that sounds like perhaps a really good upbeat note to end the conversation on. It sounds great. And listen, guys, obviously wishing you all the best of success for 2025. It looks like it's going to be an interesting, exciting year.
Thank you. The same to you.
Yeah, thanks. Great to see you guys.
Yeah, thanks very much. Thank you, guys.
Okay, cool. Great to get the big man, Luuk, on. I think that's the first time we've had him on the podcast, right?
Is it? I thought he'd been on before, but maybe not.
I think it is, yeah.
But no, it's good. I mean, it's really interesting. Obviously, Deribit had a great year last year, and it looks good going into this year.
Blew through record volumes, right?
Yeah,
and open interest. Although most of that, half of that expired in December.
Yeah. But yeah, I think what the guys at Hashnote are doing is like super interesting. Again, for me, it's like just this evolution of this space, like kind of TradFi-type products, kind of wrapped in tokens, and now and the collateral piece is like so important for this space to have like quality liquid collateral. Is just going to allow, again, just like not just for Deribit, but just more broadly. I think Luuk touched on that in the conversation. Just like the broader accessibility for sort of traders across platforms, and particularly like the traditional guys coming in who are going to want to use collateral that kind of looks and feels like stuff they're used to.
Yeah.
So like this kind of what with this USYC and like repo based collateral and stuff like that, people just understand it. So it's really interesting. Again, I think the deeper like we see these integrations, then it's just going to like help facilitate like cross exchange arb and just the volumes across sort of trading. So yeah, really interesting. Great seeing what they're doing, and they all sound as excited as I am, as you are for what lies ahead in 25.
Cool.
So it's great. So what about what's the vol world doing?
What is the vol world doing? It's not doing that much. So over the holidays, you generally expect Realize to calm down a bit. It kind of held in there before the last week. It was kind of a bit choppy, as you said, testing that 92K area on Bitcoin. But as those levels held, Realize vol has come down into the 30s on both Bitcoin and Ethereum. So Ethereum was having much wilder swings like in the most of December. but it has calmed down a bit now. So I think realize it's only at around 37 on ETH. It still does hold a 10 vol premium on implieds versus Bitcoin. So it seems to have established itself again as the higher beta asset. It's trading 10 vols over. That's kind of the baseline level now.
So like, everyone thinks we're going to still get the big move in ETH.
We've still got a call bid. We've still got a higher call bid on ETH than we have on Bitcoin by about 2 vol points across the curve. So Bitcoin's kind of flat skew in the front, kind of moves up towards about 5 vols in the back for calls. And then ETH is kind of 2 vols in the front, moving out to about 7 in the back. So ETH definitely still thought to be the one that's got the upside this year. But I mean, how often did we see that happen last year? And it just the ETH Bitcoin cross is still not really out of its downtrend. It's pretty unconvincing. Every time it does pop, it gets faded. So I find it hard to really get too excited about ETH until the price action proves itself. You know what I mean?
Yeah. But there's nothing in the vol market at the moment. Then there's no sort of real signs of positioning for some like.
We do continue to see bullish flows, but because the realized vols collapsed into the 30s, the front of the curve has got hammered. So the front of the curve lost about 10 vol points. It's gone into quite a steep contango again. There's not a material hump like in that inauguration bucket, as I said. So generally, you know, people are rolling out call exposure maybe to March. You know, there's like 110K up to 130K calls in March being traded in Bitcoin, for example. There's some like 5,000, 6,000 call spreads trading in ETH, some Jan 4,000 calls as well in ETH, outright bet there. So people, you know, there are a few bets around, and I'd say it's about 80% call flow relative to put flow.
Yeah. Is there nothing in there in the curve for obviously non-farm payrolls on Friday?
No, I mean, generally, like, it's hard to know the exact read-through on crypto for these macro data points, I would say.
Yeah, see, all I'd say to that, like I feel now that the market has completely kind of really, well, priced out the Fed. I don't think anyone thinks the Fed are going to do anything now till March, and they maybe got, well, I think we priced for 1.5 cuts this year. Feels like too little for me. And I kind of feel that, again, like, careful like not to keep just talking my own book, but I feel there's an asymmetry in terms of if we get like a decent like non-farm payroll print, then nothing really changes, right? Okay, well, we know the Fed aren't going to be in a rush to cut rates, but if it was a really like shit print, then all of a sudden, and bear in mind that happened back in, what was it, just before September, October, when they cut 50 bips, and they had a really poor print, and they panicked and they kind of cut 50 basis points. I think the asymmetry is that we get a weak non-farm payrolls, and then there's going to be a rush to price more in for the Fed. Yields are going to absolutely drop. The dollar's going to drop, and I actually think that could be quite a catalyst. So,
I feel like hasn't the Fed turned a bit too political though? And it's like, you know, is that going to happen? He's done a bit of a hawkish U-turn in December already. He's not going to do a dovish U-turn before Trump gets in, surely.
I love a conspiracy as much as anyone, right? And clearly Jay Powell like loves the Democrats, and he doesn't like Trump very much. However, like I don't know if they're that political, like in the sense of, yeah, I mean, God, they had the fastest rate hiking cycle like in history, arguably, depending on how you look at it, like under the Democrats, right? So he didn't go that easy, and like. I think they just, the hawkish turn, they just kind of panicked because actually the data started to come through really strong again, which I think is because of that pre-election spend, sugar high, worried about inflation. They've hit that sticky part of inflation again, and they're going, oh shit, like we need to rein it in a bit. So I understand why they flipped hawkish. Again, I think they need to stop just looking at every data print and like calm down a bit. But so I don't buy into this idea that, oh, Trump's in now, so we'll be hawkish and like try and make life difficult for him. Okay. I don't believe that. I think the data is what led them there. And yeah, I think they'll panic if they get a really weak like labour market report. And yeah, and if anything, you know, Trump and that's going to be putting on under pressure to cut. And I don't know if they're that brave to you know, to really kind of just go, well, no, I'm not doing that. But yeah, I think this Friday is actually more important than what everyone seems to think.
Okay.
But again, the asymmetry, if it's just, again, labour market looks okay, like Fed don't need to rush and cut, then that's where we're priced.
Maybe it's worth picking up some gamma for this week then.
Yeah. Thank me later. Do that. How and just I guess to sort of finish, how are you positioned at the moment? I'm always interested in that.
Yeah, so I had lightened up the book quite a bit, to be honest, going into the holidays. I didn't want to have a lot on. I had like a call fly structure that was trying to make money from the market grinding up towards 100k.
Right.
But then it didn't look like that was going to happen for that Friday expiry in December. So kind of rolled it out to 10th of Jan, thinking we would get a bit of a pop in early Jan, and we did get that. So we got the pop. So I'm kind of been monetizing that tactical trade now after this little pop. But overall, I'm fairly light on my hedges, probably at 20% on ETH, close to 0 on Bitcoin right now. It's just kind of letting the long run. Still think January has the potential to be a positive month. I want to see how this market behaves into Trump actually getting in and the kind of noises that he's making. But yeah, I'll be looking to put. I mean, I have got some risk reversals on in February against some of my Bitcoin holdings, so I will be looking to add hedges a bit more aggressively.
Yeah.
Probably after January.
Yeah.
Right.
Yeah.
Hopefully into a rally into like 120k or something like that.
Yes.
Yeah.
Which is interesting because it's my sense in the market. Like, I mean, there's been some, like, if you look at the ETFs, there's been some decent inflows again, like to certainly yesterday, I think there's like nearly 900 and something million into the Bitcoin ETFs. Again, caveat, some of that's going to be sort of arbitrage stuff, so not just outright buying. But yeah, it doesn't feel like anyone's really positioned. Everyone's just kind of feeling the market out. First proper week back, I guess.
Yeah.
So yeah, I think there could be some interesting times over the next sort of 2-3 weeks. And I think Friday's actually probably a bigger deal than what some people are prepared for.
All right, you heard it here first, guys. That was it for the first episode back. Hope you enjoyed it. Remember, like and subscribe to the channel so we can get more and more of this information out there. And we'll catch you guys all next week. Thanks.